Right, welcome to my video for market structure, Oligopoly. And today what we are going to do is we're going to learn about King demand curve with my student. Okay, some of the keywords in King demand curve is the interdependent behavior. Of firms. Let me just minimize this so I can fit in a few more. So, what do we understand by interdependent behavior of firms?
It's the dependence of each firm with each other.
So, what the firms do is when the firms take into account the retaliation by other firms, it doesn't necessarily have to be retaliation, it could be action as well. So, when the firms take into account the retaliation or action by other firms to their own action in terms of both pricing and production. Okay. Another is trying to understand what competitive oligopoly is, or competitive behavior. When the firms will compete but not collude in market, and a good example is the supermarkets within the UK. So supermarkets compete heavily in UK, and we as customers benefit by lower prices and better
like
deals.
loyalty cards and stuff like that.
Loyalty cards is different. I'm just looking at in terms of prices at the moment, but loyalty cards, yes. Since you've brought it up, let me
non-price.
Yes, non-price competition where firms will compete to gain market share or compete to gain customers and increase their own market share. Not on price, but other factors of marketing mix, such as branding, packaging. Loyalty cards is another scheme. Location, etc. Yes, price, place, promotion. So all these others are non-pricing factors. Another thing we need to take into account is so we've got interdependent behavior, we've got a competitive oligopoly, non-price competition. So the other factor I was talking about is joint profits. When we are looking at collective profits of all firms in a market or industry. Right, these are some of the keywords that comes to my mind, trying to understand King demand curve. So let's try and understand what King demand curve is. I'll make this layout blank. So what I've got is, let me do this in grid lines to make it better in terms of drawing my graph with you. So I've got my y-axis, I'm plotting my x-axis, and as usual I've got my quantity and I've got my pound sign over there, price or cost. And let's say in the market there is a price at that point. Let's say that's where the market is. So at that dot we've got the market clearing quantity at Q1, and we've got the market price as P1. Now let me just put my explanations over here in this box, and yep, format the shape, no fill. Let's have the line color solid as black. Okay. Edit text. To fit in a lot, I'm going to make that size 12. Right. So at P1, Q1, I'll probably have the black. Yeah. At the dot A, so I need to put this dot, label it as A. Yep. At the dot A, the market price is price P1. Market price is P1, and market clearing quantity is Q1. And right now above this point A, what we'll find the market demand curve is the PD of this is greater than 1, and it is quite elastic, as we can see. So why do you think that would be the case?
Is that because if a firm were to increase their prices, they would effectively be, or it would result in less market share because they would have less, because the other markets would keep their prices.
Markets or the firms?
The other firms, sorry,
Yeah.
would keep their prices at the previous lower market.
They'll
price.
keep the price same. They won't change
Yeah,
it.
they won't change it at all. Yeah.
And then customers can actually switch. So to the firm. So
Switch.
there is no thing that's going to hold them. So the customer's priority is the price over here. So at above point A, the market demand curve PED is greater than 1, because if the firm decides to increase price, other firms will leave their price as it is, and customers will switch to other firms to benefit from lower prices. Now the thing to understand is customers are switching from one firm to the other to benefit from lower prices. So what sort of goods have you got? Are they very identical goods, or are they very least identical? There is product differentiation.
Very identical goods.
They're very identical, isn't it? So they're perfect substitutes sort of thing.
Homogeneous.
Homogeneous, yes. I wouldn't say perfectly homogeneous,
Yeah,
but yes.
Thereabouts.
Below the point A, the demand curve is very inelastic. And why would that be?
Because if the firm were to decrease their price, then the other firms in the market would also follow the decrease in price.
So yes, you're absolutely right. Below the point A, the AR curve is inelastic, or PED is less than 1, because if a firm reduces their price, others will reduce price in fear of losing their market share. And customers do not switch because they know the prices are falling down, so they're actually benefiting. So there is a keyword over here. We will just put that down. Price war. And let's go back to keywords and put in price war. So what would be price war?
Is when firms in the market are constantly changing their price to
Dropping their prices,
dropping
isn't
their
it?
prices,
Yeah. So when firms in market are competing and dropping their prices constantly to win over consumers. So who do you think is going to win? The customers in this case, the firms that are competing, who's going to?
Well, if it's assuming that the price war is still going on, then it'll be the consumers in the end, because the consumers will be getting, they'll be having basically.
So consumer surplus will increase, isn't it?
Exactly, yeah.
So with falling prices, plus will increase and producer surplus will decrease. So consumer is the final winner and firms lose out. Yeah. Okay, let's go back to our diagram. So at the dot we've discussed now the PD is less than 1. Why? Because all the firms are reducing their price. And this is our average revenue or our demand curve. Right. So from this we need to draw our marginal revenue curve, which is, if we remember from our production theory and cost curves, our production and cost curves theory, and our revenue theory, yes, the marginal cost curve is twice as fast falling as compared to the AR. And the first one, we are drawing it from the one above the dot, and then the second one we will draw based on the second segment, the inelastic demand curve. That's our marginal revenue curve. And let me just make this line dashed. So now between the point X on the MR and Y, this part is discontinuous. Let me format the shape. So this part, region between X and Y, is discontinuous. This is because of the kinked. Now what this also means is, if we have our marginal cost curve, which is passing through the through the discontinuous section, of this X and Y, and as we know, firms maximize profit where MC is equal to MR, and we've got the price. So the MC curve passes through the discontinuous region, of the MR curve. As long as it is inside the discontinuous region, the firms will not change price. Why? Because they are in fear of losing market share to other firms. So I've drawn three situations over here. MC1, which is the original. Then I've got the MC2, where MC curve or the cost of manufacturing additional units have actually gone up. And then I've done the third one, which is where the marginal cost has fallen, but the firms are maintaining the same price. So as long as MC curve is within XY, the firms will resist changing price due to fear of reaction by other firms, and in process will either sacrifice or gain supernormal profits. So if I drew another line from here to there, so I can say originally it was over here. This was this entire box was the profit, but if the MC rose, then it's being reduced, or if it's falling, then the supernormal profit is actually increasing. And I could label this as, let's say, L, and so all I'm saying over here is, as long as the marginal cost curve is inside the discontinuous region, the firms will not change their price. This is also known as price stickiness. If the marginal cost curve even breached the marginal curve, what we'll say is that the situation we were explaining, let's say over here, that the change or the quantity lost is higher as compared to the change in price, which proves the theory that Y above the PD is elastic. You can see the amount of quantity lost over here
Greater than the amount of
is greater than absolutely
the price.
than the change in the price. And the same can be seen if this breaches and goes down. Any questions so far?
Oh, how is the difference between, how is the discontinuous region calculated? So how
These are some of the weaknesses of the King demand theory. This is because of the kinked. The discontinuous region is because of the kinked, and the difference between the two is because of the price elasticity of demand. Okay, now, so as I said earlier on, there are certain weaknesses or limitations to the King demand theory. Did I explain to you how this original dot A was reached at, or the market equilibrium? So that's one of the weakness. Does the theory take into account all the other means of competition, non-price competition?
no?
So that's another limitation. Also, the theory does not take into account if there is a price war and someone is using predatory pricing to get rid of competition, and in the long term the price is going to go back up, so that is not even taken into account.
So is that the same point as the fact that is assuming that if a firm did increase their prices, assuming that no, the firm would also increase their price?
If the firm reduces their prices to get rid of competition. Right, so over here I will conclude my king demand theory, and keep watching and keep subscribing to my channel. And if you need any help, you can also visit our website. Right, have I got it correct? Yes. Thank you.